Hey guys, I'm Greg Hardy and I want to welcome you to my channel. Imagine getting paid passive income just for owning a piece of a company. No, it's not a fantasy. It's the power of dividend investing. And in this video, we're going to dive into how you can turn your investments into a steady stream of income and build wealth over time. Now, whether you're a seasoned investor or just starting out, discover why dividends might be your ticket to financial freedom. We're also going to analyze the point at which your dividend portfolio really takes off. For those of you interested in dividend stocks, or mutual funds and ETFs for that matter, I think you'll find some real value in this video. I recently did a video on why net worth explodes after $100,000 that I encourage you to watch too, so I wanted to do another video similar to that one, but take it a step further. By the end of this video, I want you to know what dividends are, what are some good investment options, and at what point the income from your dividend portfolio will explode. But before I do that, I ask that you hit that like button and also consider subscribing to this channel if you're interested in growing your wealth. It will also allow this video to reach a wider audience and help even more people. Now let's get started. Investing in dividends can be a smart strategy for many reasons. First, dividend-paying stocks provide regular income through payments made to shareholders, which can be particularly beneficial for those looking for a steady cash flow, such as retirees. These stocks are often less risky because companies that pay dividends are usually well established and financially stable. When you reinvest your dividends, you can buy more shares, which helps your investment grow faster and faster over time due to the power of compounding. Additionally, in many places, the taxes on dividends are lower than on regular income, making them a tax-efficient way to earn money. Dividend payments can indicate a company's financial health and confidence in its future. Companies that pay dividends often show a disciplined approach to managing their money and a focus on rewarding their shareholders. Over time, dividend-paying stocks have often performed better than those that do not pay dividends. Plus, as companies grow and increase their dividends, these payments can help protect against inflation. Overall, investing in dividends can offer a stable income, potential growth, and a bit of a safety net, making it a compelling choice for many investors. If you're interested in knowing how to calculate how much dividend income you need to live off of, I'll leave a link to a video that I recently did on that topic in the description or at the end of this video, so be sure to check that one out too. Several well-known companies regularly pay dividends to their shareholders, making them popular choices for investors seeking a steady income. Apple is one such company. Famous for its iPhones and other tech products, Apple pays dividends every few months and has a history of increasing these payments, showing it's in good financial health. Another big name in tech, Microsoft, also pays regular dividends. Microsoft, known for its software and cloud services, has consistently paid and grown its dividends over the years. In the consumer goods sector, Procter & Gamble is a key player. This company owns many household brands like Tide and Pampers and has a long history of paying dividends, which makes it a favorite among investors. Similarly, Coca-Cola is another well-known company that consistently pays dividends. With its global presence and strong sales, Coca-Cola is able to provide reliable dividend payments. These companies, among others, offer regular income and potential growth, making them attractive for dividend-focused investors. Owning dividend ETFs or exchange-traded funds instead of individual stocks can offer several benefits, especially for those of you looking for simplicity and diversification. First, diversification is a major advantage. A dividend ETF holds a variety of dividend-paying stocks, which means you're not relying on the performance of just one company. This can reduce the risk because if one company in the ETF performs poorly, the impact on your overall investment is lessened. Some popular ETFs that pay dividends, like SCHD from Schwab or VYM from Vanguard. Second, dividend ETFs offer convenience. Instead of spending time researching and managing multiple individual stocks, you can invest in a single ETF that automatically includes a broad range of dividend-paying companies. This can save you time and effort, making it easier to manage your investments. Going back to SCHD and VYM, SCHD is comprised of around 100 stocks and currently pays a dividend of 3.4%. VYM is comprised of about 450 stocks and has a dividend yield of 2.85%. Lastly, dividend ETFs often come with professional management. They are typically managed by financial experts who select and monitor the stocks within the ETF, ensuring that the fund continues to meet its income and growth objectives. This can give you peace of mind, knowing that your investments are being overseen by professionals. Overall, dividend ETFs can provide a simpler, more diversified, and professionally managed way to invest in dividend-paying stocks. A dividend portfolio's value can explode over time due to the power of compounding and consistent dividend growth. When you invest in dividend-paying stocks or ETFs, you receive regular payments from these companies. If you choose to reinvest these dividends instead of spending them, you buy more and more shares. Over time, this reinvestment process allows you to earn dividends on an increasing number of shares, leading to a snowball effect where your portfolio grows faster and faster. Another key factor is dividend growth. Many companies not only pay dividends, but also regularly increase them. When a company raises its dividends, you receive more money for each share you own. If you reinvest these growing dividends, your portfolio can grow even quicker. This combination of reinvesting dividends and benefiting from dividend increases can significantly boost the value of your investment over the long term. Market performance also plays a role in the growth of a dividend portfolio. While dividends provide a steady income, the stocks themselves can also increase in value. If the companies you invest in grow and their stock price rise, the value of your portfolio will increase too. This means you benefit both from the income generated by dividends and the capital appreciation of the stocks. Patience and time are crucial. The real power of a dividend portfolio often becomes apparent after years of consistent investing and reinvesting. By staying invested and allowing your dividends to compound, you can potentially see explosive growth in your portfolio's value, especially as the effects of compounding become more pronounced over time. This makes dividend investing a powerful strategy for building wealth. So now let's apply what we know and see where the dividend growth really explodes. The first thing to know is that the rate at which your portfolio grows depends on the average dividend rate of your portfolio. There are several dividend calculators online, but I'm using this one from MarketBeat. Let's use Coca-Cola, for example, which has the ticker symbol KO. Let's say we bought 100 shares at the current price of $62.93. The dividend yield for Coca-Cola is 3.14%, and they pay it out quarterly. There's an expected annual dividend increase of 3.91% and an expected share price increase of 3%. We will keep the dividend tax rate at 0 because that number will be dependent on different things, including the account that holds it. If it's in a Roth IRA, it would be 0 since all gains are tax-free. Let's see what this looks like over 20 years. This also assumes that Coca-Cola is the only stock you buy and that you buy $6,000 every year and reinvest the dividends. That's not a smart move since diversification is key, but this is just an example to see how dividends grow. So to get your $6,000 back is somewhere between 16 to 17 years. Now let's look at a fund that's primary focus is providing dividend income to its shareholders, and that's JEPI, or JEPI, which is an ETF from JP Morgan Chase. JEPI pays a monthly dividend, so let's use that same $500 per month investment and see the difference. To get to your goal of $6,000 per year of income, it would take between 8 to 9 years to achieve, much faster than the 16 to 17 years that it would take on Coca-Cola. Does this mean that JEPI is a better investment than Coca-Cola? No, it doesn't. It's really up to you to decide what type of investor you want to be and what your goals are. Stocks that pay higher dividends often grow slower than those that don't because they are typically mature, stable companies with less room for rapid expansion. These companies generate consistent profits and choose to return a portion of those profits to its shareholders as dividends rather than reinvesting them into the business for growth. This makes high dividend stocks appealing to investors seeking steady income, especially in stable, established industries. In contrast, companies that don't pay dividends usually reinvest their earnings back into the business to fuel growth. These companies, often found in fast-growing sectors like technology, have more potential for significant stock price increases. While these growth stocks can offer higher returns, they also come with higher risks and greater price volatility. Investors looking for capital appreciation might prefer these stocks, while those seeking regular income might favor high dividend stocks. Dividend-paying stocks provide regular income, which is great for those seeking steady cash flow, like retirees. These stocks are often less risky since the companies are usually well-established and financially stable. Reinvesting dividends helps your investment grow faster through compounding, and dividends can be tax efficient. Companies that pay dividends often indicate strong financial health and a commitment to rewarding shareholders, making them a solid choice for many investors. The explosive growth of your dividend portfolio really happens over time due to the power of compounding and consistent dividend growth. Reinvesting your dividends allows you to buy more shares, leading to a snowball effect. Dividend increases from companies also boost your income, accelerating your portfolio's growth. Patience and time are crucial here, as the real power of a dividend portfolio becomes apparent after years of consistent investing and reinvesting. The strategy can significantly boost your portfolio's value in the long run. If you want to learn more about growing your wealth, then check out this video right here. But before you do that, don't forget to like and subscribe. Thank you all so much for watching. I really hope you liked this video and that you got something out of it. I'll see you in the next one.